The stock market is a fascinating realm. It's a place where companies grow and investors seek profits. Amidst the complexities of this world, stock splits emerge as significant events. They pique the interest of seasoned investors and newcomers alike. But what exactly are stock splits and why do they command such attention? Imagine a company with shares trading at a high price. This high price might seem intimidating to some investors, especially smaller ones. A stock split steps in to address this. It makes the shares more affordable and accessible. This can attract a wider range of investors, boosting liquidity and market activity. Stock splits are not just about numbers, they are about perception and opportunity. A split can signal that a company is confident in its future prospects. It believes that its growth trajectory justifies making its shares more readily available. This signal can be particularly potent in a bull market, where investor sentiment is already optimistic. Understanding stock splits is crucial for navigating the stock market effectively. They offer valuable insights into a company's strategy and potential future performance. By grasping the mechanics and implications of stock splits, investors can make more informed decisions. They can potentially capitalize on the opportunities these events present. A stock split is a corporate action that increases the number of outstanding shares of a company's stock. This is a strategic move often employed by companies to make their shares more affordable and attractive to investors. This is done by issuing more shares to existing shareholders. Essentially, the company divides its existing shares into multiple new shares. The key aspect to remember is that the total value of the company remains the same. The market capitalization, which is the total market value of a company's outstanding shares, does not change. This means that a stock split does not inherently change the value of an investor's holdings. If you owned a certain percentage of the company before the split, you still own the same percentage after the split. Think of it like cutting a pie into more slices. The pie itself doesn't get any bigger, but the number of pieces increases. You still have the same amount of pie, just in smaller pieces. This analogy helps to visualize how the overall value remains unchanged. Similarly, a stock split divides the company's equity into a larger number of shares. This can make the stock more accessible to a broader range of investors. Each share represents a smaller portion of ownership. This means that while you have more shares, each one is worth less individually. The split ratio determines the number of new shares issued for each existing share. Common split ratios include 2-for-1, 3-for-1, and so on. For example, in a 2-for-1 stock split, shareholders receive 2 shares for every 1 share they own. This effectively doubles the number of shares they hold. If a company had 100 million shares outstanding before the split, it would have 200 million shares after the split. This increase in the number of shares can often lead to increased liquidity in the market. The PR value of the stock is also adjusted proportionally. This means that the nominal value of each share is reduced in accordance with the split ratio. This ensures that the total value of the outstanding shares remains consistent. The overall market value of the company does not change as a result of the split. Stock splits can be confusing for some investors. The sudden increase in the number of shares can be perplexing if one does not understand the underlying mechanics. However, understanding the basic mechanics can help demystify the process. By grasping the concept of stock splits, investors can better navigate their investment strategies. It's essential to remember that while the number of shares changes, the underlying value of the company does not. The fundamentals of the company remain the same, and the split is merely a cosmetic change. This knowledge empowers investors to make rational decisions based on the fundamentals of the company rather than being swayed solely by the optics of a stock split. Understanding stock splits can lead to more informed and confident investment choices. Stock splits are strategic decisions made by companies for several reasons. These decisions are often made after careful consideration and analysis by the company's board of directors and financial experts. One primary motivation is to make their shares more accessible to a broader range of investors. By lowering the price per share, companies can attract more retail investors who might have been deterred by higher prices. When a company's stock price rises significantly, it can become a barrier for smaller investors who may be priced out. High stock prices can make it difficult for these investors to buy even a single share, limiting their ability to participate in the company's growth. By splitting the stock, the company lowers the price per share, making it more affordable. For example, in a 2-for-1 split, each existing share is divided into 2 shares, effectively halving the price of each share. This increased accessibility can attract new investors, particularly retail investors, who may have been hesitant to invest at the higher price. More investors mean more capital flowing into the company, which can be used for further growth and expansion. This influx of new investors can increase demand for the stock, potentially driving up the price in the long run. As more people buy the stock, the increased demand can lead to higher stock prices, benefiting existing shareholders. Another reason for a stock split is to improve the liquidity of the stock. Liquidity is crucial for the smooth functioning of the stock market, as it allows investors to buy and sell shares easily. Liquidity refers to the ease with which shares can be bought or sold in the market without significantly impacting the price. Higher liquidity means that there are more shares available for trading, making it easier for investors to enter and exit positions. A higher number of outstanding shares after a split can lead to increased trading volume, enhancing liquidity. This can make the stock more attractive to institutional investors who require high liquidity for their large trades. This can benefit both the company and its investors. Improved liquidity can lead to tighter bid-ask spreads, reducing trading costs for investors and making the stock more appealing. Furthermore, a stock split can signal management's confidence in the company's future prospects. It indicates that the company believes its stock price will continue to rise, justifying the split. It suggests that the company expects its share price to continue to rise, justifying the split. This can create a positive feedback loop, where investor confidence leads to higher stock prices, which in turn attracts more investors. This positive sentiment can resonate with investors, further boosting demand and potentially driving up the stock price. In summary, stock splits can make shares more accessible, improve liquidity, and signal confidence in the company's future, all of which can benefit both the company and its investors. Section 4. A case in point. Reliance Industries' strategic stock split. In 2017, Reliance Industries, a multinational conglomerate based in India, announced a 1-to-1 bonus issue, which is equivalent to a 2-for-1 stock split. This move came at a time when the company's stock price had been steadily rising, making it less accessible to smaller investors. The stock split was seen as a strategic decision to broaden the investor base and enhance liquidity. Following the split, Reliance Industries' stock price experienced a surge in trading volume. This indicated increased participation from retail investors. The split also made it easier for institutional investors to accumulate larger positions in the company. This is because they could now buy more shares at a lower price. The Reliance Industries stock split illustrates how a well-timed split can benefit both the company and its investors. It can make the stock more attractive and accessible to a wider range of investors. This leads to increased liquidity and potentially higher valuations. By understanding the rationale behind such corporate actions, investors can position themselves to capitalize on the potential opportunities. Section 5. Technical analysis, post-split, navigating the charts. Technical analysis plays a crucial role in evaluating stocks after a split. It helps investors understand how the market perceives the stock and how it might perform in the future. It involves studying historical price and volume data to identify patterns and trends that can indicate future price movements. By analyzing these patterns, investors can make more informed decisions about buying or selling stocks. While a stock split itself doesn't change a company's fundamentals, it can impact technical indicators. This is because the split alters the stock's price and share count, which can affect various technical metrics. One such indicator is the moving average. Moving averages are used to smooth out price data and create a single flowing line that can help identify the direction of the trend. This indicator helps smooth out price fluctuations and highlight the overall trend. It is particularly useful in identifying support and resistance levels. After a stock split, the moving average needs to be adjusted to reflect the new share price. This adjustment ensures that the moving average remains accurate and continues to provide meaningful insights. This ensures that the indicator remains relevant and provides accurate signals. Without this adjustment, the moving average could give misleading information. Bollinger Bands are another important technical indicator that measures price volatility. They help traders understand the relative high and low prices of a stock over a period of time. They consist of two bands, plotted two standard deviations away from a simple moving average. This creates a channel that can help identify overbought or oversold conditions. After a split, the Bollinger Bands will contract, reflecting the lower stock price. This contraction can signal a period of low volatility, which might precede a significant price movement. Traders often look for price breakouts above or below the Bollinger Bands as potential trading signals. These breakouts can indicate the start of a new trend or a significant price movement. It's important to note that technical analysis is not an exact science. While it can provide valuable insights, it is based on historical data and patterns that may not always predict future movements accurately. It should be used in conjunction with other forms of analysis, such as fundamental analysis, to make informed trading decisions. Fundamental analysis looks at a company's financial health, management, and market position, providing a broader context for technical signals. By understanding how technical indicators are affected by stock splits, investors can adjust their trading strategies accordingly and potentially capitalize on emerging opportunities. This comprehensive approach can help mitigate risks and enhance the potential for successful trades.